Most people who get their first $1,000 together will do exactly what they've been programmed to do since childhood. They'll open a high-yield savings account earning 4%, maybe 5% if they're lucky, and they'll watch that money sit there, slowly being devoured by inflation while they pat themselves on the back for being responsible. And 20 years from now, they'll look back at that decision and realize it was the single most expensive mistake of their financial lives. Not because savings accounts are bad, but because at this specific moment in history, with a specific amount of capital, they chose the path of least resistance when they should have chosen the path of maximum leverage. The brutal truth that nobody in traditional finance wants to admit is this: $1,000 in a savings account will never change your life. But $1,000 deployed strategically into yourself or into asymmetric opportunities can be the seed capital for generational wealth. The difference between those two outcomes isn't luck. It's understanding what money actually is at different stages of your financial evolution. My name is Godwin. Today, I'm dismantling the conventional wisdom around small-sum investing and showing you the capital allocation framework that the top 1% actually use when they're starting with limited resources. This isn't about get-rich-quick schemes or gambling on meme stocks. This is about understanding the mathematics of wealth building that Wall Street doesn't teach because it doesn't generate fees for them. If you're the type of person who wants financial clarity that cuts through the noise, who understand that real wealth is built through strategic thinking rather than following the herd, you might want to join this network by subscribing. Let's begin. Before we talk about where your first $1,000 should go, we need to establish something fundamental that most financial education completely ignores. Money behaves differently depending on how much of it you have. $1,000 and $1 million are not the same asset class, even though they're measured in the same currency. When you have $1 million, the game is preservation and steady compounding. You can afford to be conservative because even modest percentage returns translate into meaningful absolute numbers. A 5% return on $1 million is $50,000. That's a salary. But a 5% return on $1,000 is $50. That's a nice dinner, maybe, if you're being modest about it. This mathematical reality creates what I call the capital phase problem. Most financial advice is designed for people in the preservation phase of wealth, but it gets handed down to people in the accumulation phase where it becomes actively harmful. When a financial advisor tells a 23-year-old with $1,000 to build a diversified portfolio of index funds, they're not giving bad advice in the abstract. They're giving advice that's misaligned with that person's actual position in the wealth-building journey. The opportunity cost of following preservation phase strategies when you're in the accumulation phase is staggering. And this is where we need to talk about a concept that separates sophisticated investors from everyone else: asymmetric returns. An asymmetric opportunity is one where the potential upside dramatically outweighs the potential downside. In traditional investing, if you buy an index fund, your upside is roughly the market average, historically around 7 to 10% annually after inflation. Your downside is potentially losing a significant portion of your investment and crash, though historically markets recover over time. This is a relatively symmetric bet. The upside and downside are in the same general neighborhood. But there's another category of investments that most people never consider, primarily because they don't look like investments in the traditional sense. These are the asymmetric bets. And the most powerful asymmetric bet available to someone with $1,000 and limited existing income isn't in the stock market, isn't in cryptocurrency, isn't in real estate. It's in themselves. Specifically, it's in acquiring high-income skills that the market desperately needs. Here's the uncomfortable question that nobody wants to sit with. If your current skills are worth $40,000 a year to the market, and you invest $1,000 to acquire skills worth $120,000 a year, what's your return on that investment? Let's do the math because the numbers are almost obscene. The difference between those two income levels is $80,000 annually. If that skill acquisition costs you $1,000 and maybe 3 months of intense effort, and that new income level persists for even 5 years, you've generated $400,000 in additional earnings from a $1,000 investment. That's a 40,000% return. Find me an index fund that does that. Find me a stock that does that with any consistency. You can't, because those returns don't exist in traditional financial markets. They only exist in the market for human capital. And this is precisely why the wealthy think about their first dollars so differently than everyone else. When most Americans get their first $1,000 together, their entire mental framework is shaped by the conventional financial wisdom they've absorbed through decades of conditioning. Save for retirement, they're told, max out your 401k, build an emergency fund, open a Roth IRA. And none of this advice is wrong in the abstract. In fact, it's quite sound for someone who already has a high income and is looking to optimize their tax situation and build long-term wealth. But for someone who's currently earning linear income from a 9-to-5, someone whose ceiling is capped by the hours they can trade for dollars, the advice is putting the cart before the horse. You're being told to optimize the storage and growth of money before you've optimized the production of money. It's like someone teaching you advanced fuel efficiency techniques when your car only has a 1-gallon tank. The bottleneck isn't efficiency. The bottleneck is capacity. The Federal Reserve has spent the last several years demonstrating something that should terrify anyone relying on traditional saving strategies. The purchasing power of the dollar is not stable. Inflation isn't just a number on a government report. It's a tax on everyone holding cash and cash equivalents. When you put $1,000 in a savings account earning 5% while inflation runs at 3 to 4%, you're not growing wealth. You're treading water at best, slowly drowning at worst. The math is brutal but honest. Your real return after inflation is maybe 1 to 2%. On $1,000, that's $10 to $20 a year. Meanwhile, the skills gap in the American economy continues to widen. Companies are paying premium rates for specific capabilities that are in short supply. Copywriting that converts, sales skills that close, financial modeling, software development, video production, media buying. These are the skills that command six-figure salaries that allow people to break free from the linear income trap where they trade hours for dollars with no leverage. The question you need to ask yourself is this: what would happen to your income potential if you spent the next 90 days intensively developing a high-value skill? Not casually, not as a hobby, but with the same intensity that an elite athlete brings to training. What if you took that $1,000 and invested it in the best course, the best coaching, the best books, the best tools to accelerate your skill acquisition in an area the market is screaming for? This is where the objections start to rise. And I want to address them directly because they're predictable and they're the reason most people stay stuck. The first objection is that investing in yourself isn't a real investment because you can't see it in a brokerage account. This is a mental trap created by the financial services industry, which makes its money by managing your assets, not by improving your earning capacity. The IRS doesn't care whether your wealth comes from capital gains or from a higher salary. A dollar is a dollar. And the tax implications of earned income versus investment income at lower wealth levels are actually not as significant as people make them out to be, especially when you consider the Roth IRA as an eventual vehicle once your income has increased. You can't invest in a Roth IRA if you don't have income. You can't max out a 401k if your employer doesn't offer one, or if your salary is too low to afford the contributions. These vehicles become powerful tools once you've solved the income problem, but they're useless for solving the income problem itself. The second objection is that there's no guarantee skill development will lead to higher income. This is technically true, but it reveals a misunderstanding of risk. There's also no guarantee that the stock market will return 7% over the next decade. There's no guarantee that inflation won't eat your savings. There's no guarantee that your company won't lay you off. All investing involves risk. The question is whether the risk-reward ratio makes sense. And when you compare potential outcomes, investing in high-income skills with $1,000 has a convex payoff structure. The worst case is you learn something valuable, but don't immediately monetize it. The best case is you multiply your income several times over. That's asymmetry. That's the kind of bet sophisticated investors look for. Now, let me be specific about what this actually looks like in practice, because I don't want this to be abstract theory. If I had $1,000 right now and needed to maximize my financial position over the next 1 to 3 years, here's the capital allocation framework I'd use. The first allocation is to skill acquisition, and this should take the majority of the capital, probably $600 to $700. The specific skill matters enormously. You want something that has high market demand, high income potential, and can be developed relatively quickly to a competent level. Sales is the meta skill because it underlies almost every high income activity. If you can sell, you can write copy that sells. If you can sell, you can close deals. If you can sell, you can raise capital. But sales in 2026 looks different than it did a decade ago. It's digital. It's about understanding psychology and persuasion in written and video formats. It's about building funnels and systems. $1,000 invested in the right sales training, the right copywriting course, the right coaching program can completely transform your earning capacity within months, not years. The second allocation is to tools and infrastructure, maybe $200. This is the unsexy but necessary spending. A proper domain name, a basic website, software that enables you to do your work efficiently, good headphones for sales calls, a decent microphone if you're creating content. These are force multipliers that make your newly acquired skills actually deployable in the real world. The third allocation is a small asymmetric bet in something with convex outcomes. I'm talking about maybe $100 or so. This could be a speculative position in a small cap company you genuinely understand. It could be cryptocurrency if you've done real research and understand the technology. It could be buying a small amount of a digital asset or domain that you think could appreciate. The point of this allocation isn't to get rich. It's to stay engaged with markets, to learn how investing feels emotionally, and to give yourself some exposure to potential outliers. Treat this as tuition for learning about yourself as an investor, not as a serious wealth-building strategy. Notice what's missing from this framework. There's no emergency fund allocation. There's no Roth IRA contribution. There's no index fund purchase. And I can already hear the traditional finance world screaming. But here's the reality. At $1,000, with presumably a low income, these traditional moves are suboptimal. You cannot outsave a low income. The math doesn't work. An emergency fund of $1,000 will cover what? Maybe a week or two of expenses in a real emergency. It's not actually providing the security you think it is. What provides real security is having skills that are valuable enough that you can generate income on demand. What provides real security is having income that exceeds your expenses by such a margin that you can rebuild savings quickly if they're depleted. The traditional advice has the sequence backwards for people in the accumulation phase. There's another dimension to this that we need to discuss, and it's the psychological trap that keeps most Americans on a hedonic treadmill. When you work a 9-to-5, your expenses tend to expand to match your income. You get a raise, you upgrade your apartment, you get a bonus, you take a nicer vacation. This lifestyle inflation means that most people never actually accumulate capital because every increase in income is immediately absorbed by a corresponding increase in spending. The way out of this trap isn't through willpower and aggressive saving, though those help. The way out is through building income sources that feel separate from your identity and lifestyle. When you develop a skill that allows you to take on freelance projects or consulting work or create digital products on the side, that income often stays segregated in your mind. It doesn't feel like your money the same way your salary does, so you're less likely to spend it on lifestyle upgrades. This is a psychological hack that sophisticated wealth builders use. They create income streams that bypass their normal spending psychology. Let me ask you something uncomfortable. If you've made it this far in this video, you clearly care about financial optimization. You're clearly someone who consumes information about building wealth. So why isn't your income higher already? Is it because you lack information? In 2026, with the entire corpus of human knowledge available on your phone, information scarcity is not your problem. Is it because you lack opportunity? In the largest, most dynamic economy in human history, with the internet enabling anyone to sell to billions of potential customers, opportunity scarcity is not your problem either. The bottleneck for most people is not information or opportunity. It's the willingness to do what they already know they should do. It's the gap between consumption and implementation. You can watch 100 videos about building wealth, and your bank account won't move a single dollar. But a single hour of deliberate practice on a high-value skill, a single sales call, a single client project, will move you forward more than a year of passive consumption. So here's my challenge to you as we wrap this up. Take that $1,000 or whatever capital you have available and ask yourself honestly, what allocation of this money would make me genuinely nervous because of how much growth it demands of me? If the answer is a savings account, you're not thinking big enough. If the answer is an index fund, you're optimizing for the wrong phase of your journey. The investments that change lives are the ones that force you to change. They're the ones where the money is just the entry ticket, and the real investment is the time, energy, and identity evolution you put in afterwards. The wealthy don't think about their first dollars the way the middle class does. They don't see that initial capital as something to protect. They see it as ammunition to be deployed strategically, as fuel to be burned in pursuit of escape velocity from linear income. They understand that $1,000 saved is just $1,000, but $1,000 invested in the right skill, the right relationship, the right asymmetric opportunity, can be worth 100 times that within a few years. The question isn't really how to invest your first $1,000. The question is what kind of investor, what kind of earner, what kind of person do you want to become? The $1,000 is just the first test of whether you'll make that transformation or whether you'll do what everyone else does and wonder years from now why your financial position never changed despite all the knowledge you accumulated. The right way to invest your first $1,000 in 2026 is the way that scares you a little, that demands growth from you, that has asymmetric upside, and that treats the money as a tool for transformation rather than a number to be protected. Everything else is just rearranging deck chairs on a sinking ship called linear income. The choice, as always, is yours.